you. Today is Tuesday, the 28th of July, 2026. We are close to month end, middle of the summer, Q3, this wonderful year, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Now, this week is all about international expansion, growth, scaling. So yesterday I opened the week with the first international question for our theme: can the business travel? And sometimes international, you might switch off and say, well, we're not expanding international. We are just going cross county lines or to the other side of the city or to the next state. Yeah, it worth for that too, because actually, as any business principle, when you have certain things that actually are true for whatever is an international expansion or moving your headquarters or your position and trying to replicate that or transfer that or make it available in other regions, it will look like an expansion anyway. It's a growth and a scale position, and is applicable to you too, if you would like to at least to listen how these models works. So today we are moving to the right hand side of the advisory board operating system model, which is predictability or growth and capital. And we have the partnership, the revenues, and the assets here in this section. And we're going to talk specifically about this because predictability is very, very important. For businesses going international, I'm going to use the word international or any expansion. This is where the excitement get tested. Let's put it that way. Because international revenue does not become valuable because it appears. It becomes valuable when it becomes predictable, right? So a few overseas or across the line, the borderlines, deals may look good. A new market may feel promising, a local partner may say the right thing, right? But the board or yourself as a founder or the executive team has to ask another type of questions. Do the economics transfer, right? So when I'm referring to economics, I'm referring to margins, pricing, cash timing, customer acquisition, delivery cost, partners exposure, management attention. So all these things start to get very, very interesting because it's not anymore what you're used to work with. You start to duplicate or transfer what you're doing, right? So yesterday we spoke about transferability. Last week we spoke about value of the organization. So today I think the conversation is more focused on the risk of the margin illusion. Do you really have a margin that actually justify all these things? So the business things is growing abroad or cross-border, but the cost of winning, delivering, and managing that growth is eating the value. And that sometimes is hard not only to see, but even worse, is to recognize that probably is not a good idea, right? And we are not here to discourage anybody. It's just to see how we look at this problem and what solutions we can provide before even become a problem. So problem number one is that overseas revenue can look stronger than it is. So new logos acquisition mean that new customer acquisitions, new markets, new conversations create a lot of energy, buzz. It's very exciting. But one of demand is not a repeatable revenue engine, right? So the board, you as a founder or the executive team needs to know what repeats, what converts, and what holds margin. So you cannot work as a break-even or at a loss forever. You really need to put a plan to what holds margin for your organization. Problem number two is that the trade friction eats economic faster than people admit. So local rules, customs, yes, custom delays, tariff exposures, legal complexity, language, time zones, working capital strains, all that have a cost. If those costs are not visible, the board may be approving growth that is weaker than it looks. So bear that in mind. Problem number three is that the weak economics still look like growth on paper. And this is true because you see the reporting, you see the financials, you see the dashboard, and you say, well, this is going very good. on paper. Revenue raises, but receivables worsen, or exchange rates start to erode margins, right? Delivery takes longer because actually you might not have the facility, the personnel, or the capacity to deliver as you do back home. The partner support increases, right? So you need specialized in that market to support your partners. Your own time, your own executive team, your board involvement raises, and because you cannot duplicate, you cannot be at the two places at the same time. So the local exceptions also start to multiply, and this is where the harmonization of the company start to see things going up and down, or exceptions that you're doing in one market are not applicable in your market. But the worst and happens, your own customers start to realize they are doing things in other markets that you're not allowed to happen in your own market, and that creates a lot of friction. It's very, very hard to explain, and you start to giving in not to lose the business. And then what happens? You start to erode again the organization valuation or the value of the organization. So the numbers might go up, but the quality starts to goes down. So in other words, imagine international revenue without an economic transferability, as we mentioned, is like filling a bucket with a crack at the bottom, right? So the level raises, but actually it seems actually never raises enough, but it's leaking at the bottom. So it's start to get a big problem. So as a board advisor, what I would propose to consider is the following. First, test economic transferability properly, right? So do not start with revenue, start with economics, as we mentioned. Questions that are very good questions to ask. Does the gross margin hold? And you say, well, we know that we're going to have the loss first. That's fine. But when that tips to the margin holding, does the price hold? Does the sales cycle make sense? Does delivery remain profitable? Does the support cost rises or is sustained or can be self-sufficient in the new geographies? Does the cash arrive when expected? Your collections. So if the economics do not transfer, the business is not scaling really, it is spreading. And when you're spreading things like, it's growing thinner rather than larger. Yeah, at the surface, it might look bigger, but it's thinner, so it is more fragile. The second suggestion is separate good partners from expensive partners, right? So what I mean with this is a partner is not useful because they open the door, and they do that a good job doing that. But a partner is useful or really useful when they improve your visibility, they protect your pricing, reduce the cash slippage, and make performance easier to compare across markets, right? So you can understand exactly what is your distribution channels, your resellers, your added value resellers, your ecosystem of partners, how exactly they add value to your organization. But a poor partner brings activity, so a lot of friction, a lot of noise, but a strong partner actually brings discipline. It helps you to establish your brand, your firm, your company in the new markets. And the third suggestion is use yourself as a founder or your board or your executive team test. And what I mean with this is, for example, two businesses may both move from 5 million revenue to 7 million revenue, for example, or from 10 to 12 or 13 or 15. Whatever is the case, let's say two businesses, and both are increasing their revenues more or less the same. But one becomes more fundable, meaning they get investors, the shareholders supported, the banks open line of credits, or they can increase the debt because its economics are visible and the variants are explainable. The other business becomes more fragile, as I mentioned, because the margins drop, receivables worsen, controls weaken, and the founder or the executive team or the board dependencies also raises. So the same growth number, put it that way, but a completely different value story, right? So one gets more support, the other start to get more eyebrows raising because they say, what is going on there? So this is where the advisory board helps, because it can challenge those stories before the numbers become painful, right? And people doesn't like challenge, that's fine, but the challenge is not to go against the organization or the founder or the executive team or the non-executive directors. The challenge is to say, what are we doing here? How we can help to reverse, to going from a questionable business to a very, very well supported business and funded in capital and resources. So questions that the advisory board can bring to the table are, for example, overseas demands exist. Great, but economics are not clear enough. What's going on there? Other things that would be like the partners in the new geographies are creating access. Excellent, but not enough control. So how we increase those controls? Another one might be a board is seeing revenue, which is very good, but before seeing transferability. So that revenue that you see in the dashboards or in the paperwork, it doesn't show actually what happens originally in your headquarters geographies are transferable in terms of margins and revenues in the other geographies. So you see the movement, but is that capacity transfer one side to the other or not? So that type of challenges or question protects the capital. It also protects the confidence in your organization. So predictability is not about making the future perfect. We love to have that, but it's more about making the uncertainty visible enough to manage. And then you have the controls and the risk. There's something we're going to talk tomorrow, the risk controls and the measurements and the capacity to handle them when you have to. So what you gain working with me is three things: business outcomes, differentiators, and risk reduction. In terms of the outcome is the overseas revenue that becomes easier to trust, to finance, and also to defend. In terms of differentiator, I bring and put together with you a rotate international advisory board built around the predictability milestone. So you get specialist capabilities across market entry, commercial architecture, pricing discipline, governance, finance, and reporting visibility faster than hiring one executive with a lower overhead than a big consulting firm and no talent locked in, which is very important because when you have this predictability done, which is a talent we need to move to the next milestone that could be an edge, an innovation, a transformation, governance, risk, and compliance, or your scaling plan, right? So the risk reduction is a margin illusion. You don't want a margin illusion. You want to stop approving international revenues without seeing the margin, the cash, the partners, and the asset consequences underneath, right? Because if you start to see weak reporting or things are going thinner, these are the consequences, are not the causes. You want to understand the causes that produce the things or the results that are not desirable. You want to go for a better results, but what are the causes that can produce those results? Now, let's pause it here for today and reconvene tomorrow. One exercise, as usually I leave you with one little exercise that you can do in 30 minutes or less. Let's put our visual aid here. This is before your next meeting in terms of international expansion or going to another geographies. Ask for a one-page economic transferability sheet. And this is the one that we have in front of us. And here you can show the top 5 overseas or different geographies that is not your main revenue streams. Which are the top 5? Show the gross margin by market, show the average cash timing, and show the partner exposure. And then you have to do a little something. Write a single reason each revenue stream might fail, right? Not why they are success, it might fail. And this start to show you and help you to think where the things can go wrong. But it's not for a negative side. It's just a prevention exercise. It's a risk management exercise. So you can start to see where the things were overstated or romanticized, put it that way, or the excitement started to look into the too a positive side of the things without taking care of the things actually the milestone, the pylons where you have to build all this infrastructure of going international. So if this page is hard to build or is very difficult to come up with these things, so the revenue story is not predictable enough yet. So then you have a wonderful exercise to do with your team because they say, well, if this is a very good idea, how we can make it possible. right? So tomorrow we're going to move into system, which is a bottom line of the advisory board operating systems. So once the business starts spreading across borders, weak economics stops being the only danger. Weak systems is the next milestone. Become a danger if you don't have the right performances in the business, the right governance, risk, and compliance, and your assets are not prepared to support that international expansion. So if you are a founder, a chair, non-executive director, a C-suite, and you want an international advisory board to make overseas revenue more predictable, let's have a 30-minute chat. I would love to understand where you're coming from, where you are today, what you're looking for to put together in an international advisory board, so we can build one together that actually really works, specifically milestones that can be delivered to your organization rather than a nice talk shop, as you used to call it, with advisory boards, because they meet once a month, once a quarter, but with no clear direction, no clear direction, as I mentioned, to where the business outcomes should be. Have a great day, and I'll talk to you tomorrow. Thank you. Bye-bye.